welcome to Ristal Institute. My name is Sarah, and I'll be taking you through intermediate accounting. So, under intermediate accounting, we talked about the introduction and all that, but today we are going to look at income statement calculations. In our previous lesson, we explained what is income statement and what is involved under income statement. So today I want us to dive into the calculations of income statement. So let's first look at the format of income statement. So we have two formats of income statement. We have the T account or the horizontal format. So under this horizontal format, we have what we call we have the credit side, and this is the credit side, this is the debit side, and then this is the credit side. So it's a T format. So on the debit side, we put opening stock, the amount, and then we add our purchases, the amount, then we less the closing stock, and then we get the gross profit. So under this, under credit side, that is when we put the sales with its amount. So the operating, remember, under when we are calculating income statement, we are looking whether the company is making loss or it's making profit. So then operating expenses are also put under debit side to get our net profit. So this is the it's the simplest method, but then it is not recommended. So let's look at another format. Another format, it is the vertical, or what we call the narrative format. So this narrative format, it is the one that is recommended. Most institutions and then in most organizations, they use this format. So we are going to concentrate on the format that is used. So the other format, the horizontal format, it is outdated. So the format that we are going to concentrate on, or the one that we are using, and most of the organization that uses it is the vertical, or what we call the narrative format. So when we are starting, remember we are looking for, we want to see whether the organization is making profit, or the business is making profit or loss. So we are calculating, our target is to find out. So when you're starting, remember, in a company, in an organization or in a company, you have your sales. So you start with your sales. So you put your sales. Then after the sales, you less what we call the cost of sales or cost of goods sold. So that one, under cost of sales, we have what we call the opening stock. What is opening stock? Opening stock, it is the stock that you remain with, for instance, in the previous month, because when you're preparing this income statement, you are targeting for either 1 month, you're preparing it for 1 month, or it can be quarterly, which is 3 months, or you can prepare for a year, annually. So what does it mean here? It means that the stock that you closed with becomes your opening stock. So you have your opening stock, the one that you ended with last month, it remains. So when you're starting the new month, it becomes your opening stock. So you start with opening stock, then you add the purchases, what you have bought, the new purchases that you have made. So in case, for instance, if you purchase goods and then those goods are you find out that among the stock that you've bought, among the goods that you've purchased, there are some that are spoiled, or there are some that are damaged, or there are some that are expired. What do you do as an organization or as a business? You return those goods back. So when you return those goods back, it means that you're going to remove it from your purchases, because that is not you will not count it as a purchase since you've returned them back and they will give you back your money. So what we say we deduct the any returns from the purchases. You return back the goods to where you bought them from. So that is, we subtract to get our net purchases. We return these goods to get our net purchases. So after getting our net, remember we want to get the cost of sales. So what we do now, we less our closing stock. At the end of the month, there is always that stock that you remain with. So after, it's the one that you less. You less this closing stock. You less the closing stock to get the cost of goods sold. The cost of goods sold, the goods that you have sold at that particular period. So that is what we get and we put here. So we want to get our gross profit. How do you get the gross profit? You get the sales minus the cost of sales to get our gross profit. So you get the sales minus cost of sales. So when we look at our sales, for instance, if you have what we call a sales return, they return some good back to you. You've sold some goods and then they return back to you. You have to subtract them from your sales. That is what we call sales returns. That's what I wanted to add. And then after getting our gross profit, we less our operating expenses from our gross profit. So under our operating expenses, we identify what are your operating expenses in your business. For example, we have rent, we have electricity, we have salary, and we have so many others. So you identify what are your operating expenses. So you get the total. After getting the total of the net operating, we call net operating expenses. The total, here we get the total is here. We get the total expenses, you add. Then after getting the total expenses that we have, then you have to put you add the net profit before taxes. What are the net profit? You get the net profit before taxes. If you subtract the gross profit minus the operating expenses, or minus the total operating expenses. So after getting the total operating expenses, the profit that we are getting, it is before tax. So if you have taxes that you're supposed to pay, then you less all those taxes. Those taxes for you to be able to get the net profit for the year after tax. So you get the net profit after tax. Then you add what we call retained earnings. If you have any retained earnings, then you add it. Then we less what we call appreciation. You less it, and then we get the answer. We add what we call proposed dividends. If you have dividends in your company, you add, and then also we get transfer to reverse. So the we less appreciations. So under appreciation, we have what we call the proposed dividend, that is our appropriation, or the transfers to reverse, that is appreciation, and so many others. So after getting the total, you get what we call cumulative retained earnings. So this cumulative retained earnings. So at the end of the year, we get this is what we get at the end of the year. So the profit that we get at the end of the year. So all this working, you add these things when you have them or when your business incurred them. So this is the format. But when you don't have this, it means that we are going to aim at the net profit, since we are looking for the net profit of the year. So this is the net profit is what we shall take to our balance sheet. So let's look at an example. They've given us an illustration here. They are saying this information was extracted from the books of Ugandan Blessed Enterprise Limited for the financial year ended 31st December 2021. So we have what we call, they've given us this, we have this trial balance, they've given us the particulars. We have the debit side. We have the debit side, which is in SSP, and then we also have the credit side in SSP. So they have given us cash as 800,000 SSP, and then bank as 2,500,000 SSP, and then debtors they have given us as 3 million, and then as stock, first they've said 1st of January 2022, we have the stock of 2020, we have the stock of 600,000, and then vehicle, we have vehicle cost, which is 7 million, and then equipment, which is 5 million, and then purchases, that's given us the amount as you see. We have wages, that's given us the amount as 1 million. Then electricity, they've also given us rent, bad debts, sales return, discount, drawings, and then creditors. And then we have income tax payable, purchase returns, discount received, sales, and then provision for bad debts as 1st January 2020, and then capital, they have given us capital of 7 million, and then they have given us long-term loan as 2 million. So the total was 27,140,000. So that is the total, and then also the total of debit side and then also credit side, it's the same. So in a trial balance, the credit side should be equal to the debit side. So as you see, it has balance. And then they've given us additional information. They're saying closing stock at the end of the year was valued at 1,500,000. And then they're saying additional provision of 1% of the debtors has to be made against bad debts on 31st January 2021. And then they're also saying of the rent paid, 100,000 is for financial year commencing on 1st January 2022. And then they're also saying wages of 300,000 accrued. And then they're also saying motor vehicle are to be depreciated by 20% and equipment by 10% on the cost per annum. So let's look at this additional information. We are going to calculate it, and we are going to make sure that we come up with our journal entries for this additional information. But before that, let's first look at the note of understanding. When we talk of the statement of wages, they say wages of 300 accrued. What do we mean by accrued? Accrued, it can mean unpaid, something that is not paid. So the wages of 300 was accrued. So they said whenever an expense accrues, it must be added to the expense account figure already in the trial balance, or created if it didn't exist in the trial balance. So for instance, in our trial balance, they have given us as the trial balance, they gave us that the wages they are 1 million SSP. So we have to add this accrued wages. We have to add this accrued wages. What does it? We get the total of 1,300,000. 1,300,000. So this total, it's the one that we are going to take to the profit and loss account. It's the one that we are going to take to the statement of comprehensive income. It's the one that we are going to take to our profit and loss account. That is the income statement. It's the one that we are going to take. We are going to take this figure because the accrual wages, or we can call it as wages payable, must also be recorded under current assets. So when we go to the balance sheet later on, we shall record them under current liabilities. Why do we record them under current liabilities? Because they are payables, something that you've not paid yet. So they are payable. So all the payables, we put them under current liabilities. So in the statement of financial position, that is our balance sheet. So in this case, the 300 accrued wages or the wages payable appear in the statement of financial position as a current liability. So that is one about wages. So when we talk of rent, they say the rent of 100,000 was prepaid. So this is because much as that rent was paid for the financial year ended 31st December 2020, it is for the following financial commencing. So it was supposed to be paid on 1st January 2021, but then they paid it on 31st December 2022. So this become our prepaid rent. You paid in advance. In other words, you paid in advance. So it must be subtracted from the rent paid, since that it will cover up. It is not for that particular month, but it is for the coming month. And then it might be subtracted from the rent. So this is necessary to match the expenses accurately against revenue and to the period they relate. So we see that in this case, we have the rent as per trial balance. The rent in the trial balance, they gave us as 700. So we shall subtract the prepaid rent to get the amount of rent, which is, we subtract the 100, which we shall get the 600. So this 600 is the one that we shall take to the profit or loss account. So any expense which is prepaid in which is paid in advance must appear as current assets. Must appear. This is your asset, since it is still your money that you have paid it, but then it is put in the next month. So it is an asset. So we put it under current asset in the balance sheet or in the statement of financial position. So in this, the prepaid rent of 100 appears under current asset in the statement of financial position. So the 600 is the one that we shall put under our income statement, and then the 100,000 SSP, it's the one that it shall appear in our balance sheet. So that's our note. And then also would have given us that additional provision equivalent to 1% of debtors to be made. So the additional provision of 1%, we get that they have given us what is the amount of debtors. The debtors, they have given us that the debtors were 3 million. So we get those 3 million times 1%, which we get 30,000 SSP. So this means that there were additional bad debt expenses of 30,000. So the additional bad debts of 30,000. What are the bad debts? These are the people that you're demanding that they have failed to pay their money. So we have the additional bad debts expense of 30 SSP, which must be added to the existing figure. So we have the bad debts as the per trial balance, which they gave us 30,000, and then we add the additional provision of bad debts, which were also 30,000 SSP. So we get the total figure of the bad debts to be taken to the profit and loss account as 60,000. So the provision for bad debts, we see that it's offset from the debtors figure in the statement of financial position. So in this illustration, the additional provision was made. So we see that the provision for bad debts as per trial balance was 60, and then we add the additional provision of 30,000 to get the provision for bad debts as 90,000. So let's start. We said that they've given us additional information. So whenever you're given additional information, this is our additional information. So when you're given this additional information, what does it mean? You're supposed to come up with journal entries. So let's get the journal entries. They are telling us that closing stock at the end of the year was valued at 1,500,000. So the closing stock, what does it mean? It means that we have to get to what? We have to get two accounts. We have to get two accounts in our journal entry and we balance them. So we have what we call the closing stock as our closing stock. So the closing stock is receiving. The stock is receiving, which we put under debit side. Whenever an asset is receiving, we debit. If it is losing, we credit. And then when a liability is receiving, we credit. When it is losing, we debit. So we see that this closing stock is receiving, which is 1,500,000, and then trading, and it's receiving from trading account, which we debit it. We debit, and then we have. Let's go back and see. In our additional information, they are telling us additional provision of 1% of the debtors has to be made against bad debts. Remember, we calculated for this and we said that we get the 3 million times 1%, which we get 30,000 SSP as our bad debts. So it's in our journal entry, we shall get the bad debts as 30,000 SSP, and then the provision for bad debts, because there are two accounts. So bad debts is receiving, which we debit, and then the provision for bad debts is reducing, which we this one it's getting provision for bad debts. Bad debts it's getting for provision for bad debts, so that's why we credit it. And then in our additional information, they're also telling us that of the rent paid, 100,000 SSP is for the financial year commencing on 1st January 2022. What does it mean in our journal entry? It means that we have to get two accounts, prepaid rent and rent. So the prepaid rent was 100. So what is the rent? It means that the rent is losing out 100. That's why we debit prepaid rent. We debit prepaid rent because since it's receiving and it is an asset. And then also we credit rent. We credit rent. So in our addition we have wages. So we go back to our additional information. What does it say? It says that the wages of 300,000 accrued. Wages of 3,000 accrued. So what does it mean? We have two accounts. We have wages, and then we also have accrued wages, or what we can call wages payable. So the wages, it will be receiving, and then the accrued will be we shall credit accrued wages. And then what we call depreciation. A vehicle. They are telling us. And now additional information, let's go to our additional information. They are saying motor vehicle are to be depreciated by 20%, and equipment by 10% on the cost per annum. So when we calculate, remember we get that 20% of, we see how much was in our question, in our illustration, how much was for equipment. So we see that for vehicle, the vehicle cost it's 7 million. So the vehicle cost is 7 million. What does it mean? We shall get the 20% of 7 million is the one that we shall get is the one that has depreciated. And then also we also get for equipment the 10% of the equipment cost, which is 5 million. So that is what we shall put in our journal entry. So in our journal entry, we see that they're saying depreciation vehicle. So depreciation vehicle, it depreciates when you get the 7 million, you get 7 million, 20% of 7 million, 20% of 7 million, you get 1,400,000 SSP. And then the accumulated depreciation for vehicle, it's the same amount, we debit it. And then when we get the 10% of 5 million, we get 500,000 SSP. 10% of 5 million. 10% of 5 million. That is what we shall get, and we shall debit the depreciation, and then we credit accumulated depreciation equipment. So those are how we come up with our journal entries. So after coming up with our journal entries, then let's go to calculate the statement of comprehensive income, or we can call it the income statement, or the statement of profit and loss. So when you're calculating, you have to write, first of all, the loss is, you have to write the name of the company, then you write what are you calculating, and then you write the year. So the name of the company, which is Uganda Blessed Enterprise Limited, then the statement of comprehensive income for the year ended December 2021. So in our illustration, we have sales. So we write sales. We say we have sales. So you see the amount. How much was the amount of sales? Which we have 12 million. 12 million SSP. So do we have in our illustration that I've given us that there are some sales written? So what we do, we less those sales written. Less sales written. We less sales written. So how much was the sales written? The sales written, it was 50,000. So when you subtract, because when you're lessing in accounting, whenever you're lessing, you put that figure in bracket. So you get the total amount of 11,950,000. So that is the amount. This is the net. We can call it as net sales. Net sales. We can call it as net sales. So we go to, after getting our net sales, now what we do, we less our cost of sales. We say under cost of, you say less cost of sales. Cost of sales, all the goods sold. So under it, we have what we call, we have our closing, we have our opening stock. So you say opening stock. So they've given us an opening stock, and they've given us an opening stock. Let's check how much was given as our opening stock. How much was given as our opening stock? $600. They've given us opening stock of 600. Opening stock of 600. So you write 600,000. So we add you add purchases. You add purchases. So the purchases they have given us, we are going to write here because we have additional. We need to get our net purchases. They have given us purchase return. So we have to get our net purchases. So the purchases, they were 4 million. 4 million. So we less purchase. We less purchase returns. Purchase returns, which was 5. Purchase return was 5. Purchase return was 500,000. So when you less, we get our net purchases. Net purchases. Net purchases as 3,500,000. 3,500,000. So that is our net purchases. After getting our net purchases, what we are going to do, when you add the opening stock plus the purchases, we get what we call cost of goods available. Cost of goods available for sales. Cost of goods available for sales. So you add, which we shall get 4,100,000. 4,100,000. So we less our closing stock. We have, remember, they've given us closing stock, less closing stock. You have to follow the illustration first. You have to understand it. So we are following our illustration. So you less the closing stock. The figure it's 1,500,000. 1,500,000 to get cost of sales or cost of goods sold. You can call it cost of sales. We shall get 2 million. Shall get 2 million. 600. 2,600,000. So after getting our cost of sales, we want to get our net. We want to get our net profit. When I click it, will just go to we shall get our net profit. Net profit. So this net profit, how do we get it? We sell sales minus cost of sales. So we get our sales minus cost of sales, of course, cost of goods sold. So we get our gross profit, which is the gross profit will be 9 million. How much was our sales? Remember, we've gotten sales as 11,950,000 minus the cost of goods, which is cost of goods sales, which is 2,600,000. So we shall get 9,350,000. 50,000. So that is what we shall get as our net. As our gross. This is supposed to be gross profit. As our gross profit. We are getting our gross profit. To get gross profit, we get the sales minus cost of goods sold. So we want to, now we need to add, they've given us miscellaneous income, or we can call it miscellaneous revenue, which was discount received. So any income, we add our incomes. If you have income, you add here. So we shall say add miscellaneous in revenue or income. So under it we have discount received. So when you receive discount, that is income. Discount. But when you encounter discount allowed, that becomes our expense. So we have discount received, discount received as the amount was 80,000. So the amount is 80,000. So we less operating. So we get the total. After adding, we get the total of 9,043,000. So this miscellaneous income, we add it to our gross profit. So we shall get the amount as 9,430,000. So we shall go ahead and less our operating expenses. Less operating expenses. Rate operating expenses. So we have several operating expenses that we need to identify in our illustration. So they have given us, they said wages. We have wages. Remember, in our wages we have additional information, isn't it? They told us that they have given us wages as 1 million, and then they told us that the 300 was accrued, so which we add. So the total, it's the one that we shall add all together. They become our expenses all together, which is 1 million. We say that 1,300,000 was the one that we shall bring to the income statement. So we shall put here and we say 1,300,000. So we have what we call electricity. We have electricity, which the amount is 340,000. And then we have rent. The rent, the amount is 600. Remember, in our notes they have told us that the rent that we shall bring to, we shall remove, that given us the rent of 700. The rent of 700,000. But then they say the 100 was prepaid. So we subtract to get the net, the rent that was paid that particular period. So it's the one that we shall put to our expenses, which is now the 600,000. The 600,000. And then they have told us that we have bad debts. So we are going to follow our additional information, which they told us the bad debts. We shall bring 60,000 as our bad debts. And then also you have what you call sales discount. Sales discount, we can call it as discount allowed. It is also called as discount allowed, which is 60, which is also 60,000. And then we have also what we call depreciation. We shall add the depreciation for the vehicle, and then also depreciation for equipment, So the amount, we get the 20% of 7 million, which gave 1,400,000. 1,400,000. And then we also get 10% of this. To get the depreciation, we get 10% of the equipment cost, which is we get 500,000. 10% of 5 million, we get 500,000. And then now we get the total expenses. Hope we see whether those are all our expenses. So having checked that these are all our expenses, it means that here we have the total expenses will be 4,260,000. So to get the we are going to subtract. We want to get our net. If it is positive, that is net. It is net profit. You just write direct profit. But if you get your answer in negative after subtracting the expenses, it means that if it is in negative, that is net loss. So let's see our answer. Is it in we get the 9,430,000 minus 4,260,000. So our answer is going to be in positive. So we call it net profit. And then we will get the answer of 5,170,000. So that is our net profit. So it means that in our illustration here, the answer that we got our net profit. It means that the company is doing well. So thank you. I've come to an end of this lesson. Let's link up in our next presentation.